principles. Ever bought a stock just because everyone else was talking about it? That's herd mentality, and it's a big reason why markets experience bubbles and crashes. We see our friends getting rich on a hot new stock, and we don't want to be left out. FOMO, or the fear of missing out, is a powerful motivator. Montier warns us about blindly following the crowd. It might feel safe in the moment, but it's often a recipe for disaster. Remember the dot-com bubble in the late 90s? Everyone was piling into internet stocks, valuations skyrocketed, and then, boom! The bubble burst, and countless investors lost everything. Instead of following the herd, Montier suggests thinking independently and making informed choices based on research. Don't just buy a stock because everyone on social media is hyping it up. Do your own due diligence. Analyze the company's financials, understand its business model, and determine if the current valuation is justified. Remember, it's okay to be different. In fact, being a contrarian, going against the grain, can be incredibly profitable in the long run. While the herd is chasing the next big thing, you can be scooping up undervalued assets that others are overlooking. It takes guts to go against the crowd, but it can pay off big time. So the next time you're tempted to jump on the bandwagon, take a step back and think for yourself. Ask yourself, am I buying this asset because I believe in its long-term potential, or am I just afraid of missing out? If it's the latter, you might want to reconsider. Another common mistake? Focusing too much on short-term fluctuations. Many investors panic when the market dips, leading them to sell at the worst possible time. They see their portfolio value drop, and they immediately think, I'm losing everything. But remember, the market is like a roller coaster. There are going to be ups and downs. Montier reminds us that real wealth is built over the long run. Patience and discipline are key to successful investing. Don't get spooked by every little dip in the market. Instead, focus on the bigger picture and your long-term goals. Think about it. If you're investing for retirement, which is decades away, why are you sweating over a 5% drop in the market today? Those short-term fluctuations are just noise. What matters is the overall upward trajectory of the market over the long haul. Instead of panicking when the market dips, see it as an opportunity to buy quality assets at a discount. Remember, you only lose money if you sell at a loss. If you hold on to your investments for the long term, you're more likely to ride out those short-term fluctuations and come out ahead. Of course, this assumes you're invested in solid companies with strong fundamentals. So do your research, pick companies you believe in, and then let time work its magic. Don't let short-term thinking derail your long-term financial goals. Investing can be an emotional roller coaster. Fear and greed often take over. Ever heard the phrase buy low, sell high? Sounds simple, but in reality, people often do the opposite. When the market is booming, everyone's greedy. They see prices going up and they want in on the action, often buying at the worst possible time, right before a correction. Then, when the market crashes, fear sets in. People panic and sell their investments at a loss just to escape the pain, but remember, that's exactly what you don't want to do. Selling low locks in your losses and makes it harder to build wealth over time. Montier suggests using a rules-based approach to keep emotions in check. That way, you won't make hasty decisions based on market hype or panic. A rules-based approach means having a clear investment plan and sticking to it, no matter what the market is doing. This could involve things like rebalancing your portfolio regularly, dollar-cost averaging into the market, and having a predetermined risk tolerance. For example, you could decide that you'll rebalance your portfolio every quarter, regardless of market conditions. Or, you could commit to investing a fixed amount of money every month whether the market is up or down. Having these rules in place can help you stay disciplined and avoid making emotional decisions that could jeopardize your financial future. Remember, the goal is to remove emotions from the equation as much as possible and make rational decisions based on your investment plan. Want to know one of the best ways to beat the market? Think like a contrarian. Instead of following trends, Montier advises looking for undervalued stocks, investments that the crowd is ignoring. This approach, also known as value investing, has been used by some of the greatest investors of all time, like Warren Buffett. The basic idea behind value investing is to find companies that are trading for less than their intrinsic value. In other words, you're looking for stocks that are on sale. This often happens when a company is going through a rough patch. Maybe they've had a few bad quarters, or there's negative news surrounding the industry. The herd mentality can push these stocks down even further, creating an opportunity for savvy investors to swoop in and buy at a discount. Of course, value investing requires patience. It might take time for the market to recognize the true value of these companies, but if you're right, the rewards can be substantial. But remember, not every company that's undervalued is a good investment. You need to do your research and understand why the market is undervaluing the company. Is it a temporary setback, or are there deeper fundamental issues? If you can find companies with strong underlying businesses that are temporarily out of favor, you might just uncover some hidden gems that can supercharge your portfolio returns. And finally, Montier emphasizes process over outcomes. That means focusing on making solid investment decisions rather than stressing over short-term results. If you have a good strategy, stick to it. Over time, the right process will lead to success. Don't get too caught up in the day-to-day fluctuations of the market. Instead, focus on what you can control: your investment plan, your risk tolerance, and your emotional responses. If you're making sound decisions based on your research and analysis, the results will follow. Remember, you can't control the market. You can't predict when it will go up or down, but you can control how you react to those changes. By focusing on the process and sticking to your plan, you're more likely to stay the course and achieve your long-term financial goals. Think about it like this. If you're training for a marathon, you don't get discouraged if you have a bad run one day. You focus on the overall training plan and trust that as long as you stick to it, you'll be ready for the race. Investing is similar. There will be good days and bad days, but it's the long-term consistency that matters most. So, focus on building a solid investment process, and the outcomes will take care of themselves. So, what's the big takeaway from the little book of behavioral investing? Simple. Our minds can be our worst enemy when it comes to investing. By understanding our biases, avoiding emotional decisions, and sticking to a disciplined approach, we can become much smarter investors. If you found this summary helpful, don't forget to like, subscribe, and hit that notification bell so you never miss a new book breakdown. And if you want to dive deeper into the fascinating world of behavioral finance, I highly recommend checking out James Montier's work. And hey, if you want to grab a copy of the Little Book of Behavioral Investing, click the link in my description to check it out. Trust me, it's a game changer. Until next time, happy investing.